Kingwood Mortgage Guy. On this Tuesday, this is October the 11th, 2016, and we're talking about how to buy a home with the least amount of money and what 5-star home program options are available to you. So that's one of the premise of this meeting is. I'm glad that you are all here. I want you to use the chat function in the webinar. You'll see that. I think it's on the right side of your screen where you can chat. I probably will save all the questions to the end. So thank you for being here, and let's move on. I am the Kingwood Mortgage Guy. Why am I the Kingwood Mortgage Guy? Because I call myself the Kingwood Mortgage Guy. I've been doing mortgages in this area for the last 20 years. This actually is my 20th year. Started in 1997. So when we get to 2017, it'll be going in my 21st year. A couple ways to reach me is the Kingwood Mortgage Guy's website. I'm proud of that. This is my phone number. It's the office phone number, 281-348-9899. I am a member of the Mortgage Association, and I have an NMLS number that really just means that I am licensed to do loans in the state of Texas. And then, of course, my email is right here at mikekmg@gmail.com. So don't want you to be looking for a way to get in touch with me. You'll find that throughout the webinar that there'll be times where I'll prompt you to get in touch with me. Okay, so what we're going to cover, this is this section, and you will know that you are in the right place if you're looking why you should consider buying a home. We're going to dispel some myths about money that is needed, and there are a lot of people that don't really understand how that works, so we're going to make that clear tonight. Different programs available. There's a handful of different programs out there available. I'm not sure I'm going to give you 100% of every program that is available, but I'm going to give you the main ones so that you're going to leave with a better idea of which ones are out there. Total amount of money needed to buy. This is a really important one. A lot of people are confused about what exactly it is, how much money you need for buying a home today, and then the next one is what you should do next depending on what your decision is. So we're going to answer all those questions so that if you are in the right place, then let's progress. Does it make sense? Does it make sense to buy? So here are the questions that you need to ask yourself. Are you financially ready to buy a house? And there's a few things that are included in being financially ready. It could be stability of your income. It could be the amount of your income. It could be the way that you're using the income. So all of those things are things that we want to talk about. Are you ready emotionally? Emotionally, it means are you ready to take on the challenges that come along with being a homeowner? And that means that you have to be emotionally ready to take care of the maintenance that is around the house and to do the things that need to be done to keep a house in a good stead. I mean, a lot of people that as we age in life, we tend to be less active around the house. We kind of, I think the term I've heard said is we let the house go, and the house starts to depreciate, or it starts gaining, or it stops gaining in value and it starts depreciating because we're not keeping the house up. So when you own a home, it's kind of a big deal that you take care of it, that you maintain it, and you've got to have a mindset to do that. Not everybody has that. And another thing is you've got to be able, there's got to be some skills involved. And in my case, maybe not so much. I've got to be able to hire people to fix them. But it does help if you know how to take care of the lawn, if you listen to the garden shows, you pay attention to your roof, you look at the gutters, you do the kind of things that are kind of domestic stuff. My kids would say all the uncool stuff. The cool part comes when you sell. If you do all those things and you get back a lot of the time and the money and the effort that you put into it. So those are just some of the things that we think about. A couple others is owning versus renting is based on what's best for you, and it's your specific characteristics that are going to make a difference on this question. There's not a hard and fast absolutely yes, it's a good idea to buy versus rent. For many people, it is a better idea for them to buy as opposed to rent, but there are a lot of people that should probably continue to rent, and they're either not financially ready, they're not emotionally ready, or maybe they're just not ready in general. So next one I put on there is, are tax benefits meaningful to you? And one of the positive things about buying a home today in our economy is that you get some tax advantages. And for anybody that's starting to earn a little bit of money and you see that the government's kind of reaching in your back pocket and pulling out that money, tax advantages can be pretty helpful. And it kind of adds a little bit of a bias towards the argument of whether it's a good idea to buy or not, is when you get tax advantages. So obviously if you're making money, could be a good factor. Well, again, one of the things that we talk about a lot is, are you going to stay in the area? It's probably a bad idea to buy a house in the area and then move within 5-6 months or a year or 2 years for that matter, because it takes a while for the home to gain some appreciation. And one of the real beautiful things about buying a home is it becomes worth more for a couple reasons. One, if the economy is good and the area is growing, there are more and more people coming to the area, then it can be very good. The other thing is that you make improvements to the property and you maintain the property, and sometimes just the nature of the natural growth of an area can improve the value of the house. Now the same thing can happen in the opposite direction. There are some areas that don't do as well as others, so it's always good for you to have professionals working with you that can guide you as to where things are getting better, and there are some areas where things are getting worse, so you always want to know that. And how are you supposed to know? Well, you deal with people that know. You tap into the professional mindset out there. And then the final thing is, are you ready for the commitment? It is quite a commitment. It's a long-term commitment. It's not marriage, but at the same time, you're making a pretty big commitment to a house. You're going to be paying for it. You're going to be taking care of it. And so there is some similarities to being married to a property. You're not going to get back very much affection from it, but it's going to take care of you. It's going to shelter you, and it's going to provide a place for you to kind of hang and for it to make it your own. So anyway, those are some of the things on whether it makes sense for you to buy or not. We can always talk later specifically about your situation, and I encourage you to do that. Reach out to me at either kingwoodmortgageguys.com or on the phone number that I've provided for you. All right, home buying myths. So this is some of the stuff that people ask me consistently, and I just kind of go, where did that come from? Just not 2 weeks ago at an open house, a young couple came in. These are college graduates. They're not married yet, but they were fiancé and soon to be married, and they had been holding off on buying a home because of the belief that they needed to have 20% down. And there may have been a time, sometime in the United States, when you needed to have 20% to put down, but that is a bona fide myth. You will find that when we go over some of the programs, that there are programs out there where you put zero money down or smaller percentages down. So I was explaining to that couple that there's a good chance that they would be ready to buy now as opposed to waiting to put 20% down. You don't need any money down. Well, there are some programs out there that offer no money down, but there are not many of them. If you're a vet, there's amazing, it's probably the best loan going. The VA loan is where you have to put zero money down, and if you're smart, you can help, or you can get help from the sellers to pay for any of the money that you might have brought for closing costs and escrows and that kind of stuff, and we'll talk about that. So there are loans out there that right now in this state of the mortgage arena. There's not many that are zero down, but there's a couple. And then rent payments is more than a mortgage. Many cases, the mortgage payment is in fact less than what you could pay in rent, for sure, if you're comparing apples to apples. Now, can you find a place to rent where you pay less than you would in a mortgage? It's all kind of comparable depending on what you're trying to get, but a very nice apartment that's got a lot of amenities will a lot of times cost more than it would if you had your own house with a swimming pool and all the amenities and some of the tax advantages and the benefits of buying a house. So that probably is well, it's probably a truth, as a matter of fact. The other one that I get a lot is my credit's a little salty. I've had some traumas in the past. I'm not sure that I have good enough credit to qualify for a mortgage. And in this one, the myth is that you have to have perfect credit. Now, does it help? Heck yeah, it helps. But if you don't have perfect credit, and even if you have sometimes rough credit, maybe you're rallying back from a trauma that you had, there are a lot of loans out there, or particularly one loan that we use all the time that is a great loan for people that have had some rough credit in the past. And it allows for less of a recovery period from the trauma, whether it was a bankruptcy or a foreclosure. A lot of people that go to foreclosure, the rules are that you have to wait 7 years. Well, for this, if it's a VA program, it's 2 years. If it's a FHA program, it's only 3 years from the date of the foreclosure. And so anyway, those are things that would hopefully encourage some people. Must have 2 years on the same job. I've heard that a lot of people avoid going and looking for a house because they haven't been on their job for 2 years. Most of the programs out there allow you to get a home within 1 month of coming out of school, and they will use the 2 years that you had in school as your employment history, as your training for your job, or if it could be any kind of training. When you're changing jobs, all you really need to do is have an offer letter or even a confirmation from the employer that you're going to be working and you're going to be making X number of dollars. Now, not all lenders are that gracious. Some of them, you have to have at least 30 days worth of paycheck stubs to buy a house. But as you can see, there's a lot of variables there. But in most cases, you can start looking for a house right away, even if you're changing jobs. You just have to be a little careful about that. Getting a mortgage is a pain. Well, it can be. If you don't have your financial records in order and you have to look for W-2s or tax returns or paycheck stubs or surveys or all the kind of stuff that's a part of this program, it can be a pain because you have to dig and find from other people. If you take care of your financial information and you file your tax returns and your W-2s in a safe place, then it should be a piece of cake. We really require bank statements, paycheck stubs, tax returns, W-2s. Once you get past that, the rest of it is really stuff that you will get. You'll get homeowners insurance. So it shouldn't be too bad. And once we give you the list, that we go by and all of your information is vetted and scrutinized in an aggressive manner, I'd tell you. But most of the people that we work with end up saying that was easier than I thought. So we hope that it's not going to be a pain. We like to think that we make it as easy as we possibly can, and it's surely our intention to do so. Okay, so now we're getting down to the different programs that are available, and I'm going to throw these out. There are a couple government programs and then a couple conventional programs. FHA is one. It's a first-time home buyers program. The VA, for some reason, it's not on my, well, yeah, there it is, Veterans Administration. I'm going to go in this order. Veterans Administration program is the best program by far of all of them. The fact that you don't have to put any money down, that you have low credit scores, it has expanded ratios, and you can finance any mortgage insurance if there is some. Sometimes there's not. It's just a great loan. So VA is the top of my list as far as loans, and we'll go through that. The second one is the Fannie Mae and Freddie Mac. Those are conventional loans. Those are non-government agencies, or I don't know, maybe they're semi-government agencies. The jury's still out as to what exactly is going on with those, but I think that they still have something to do with the government. Can't tell you what. But conventional is a very good program. It has a lot of positive characteristics. It's a little bit harder program to qualify for. You have to have higher FICO scores. You have to have your debt has to be a little lower compared to your income than it would be on an FHA and possibly even a VA loan. But very good program. When people ask me if they're not when I ask them if they're not a vet, the conventional program is the program that if you were a family member or somebody that I cared about greatly, which I do all my customers, but I would put you in a conventional loan if it fits. It's a long-term loan, and the reasons for that are the way that the mortgage insurance is treated. The next one on my list is the FHA. The FHA is a great program, particularly for first-time home buyers. It offers low down payment. It allows the maximum higher ratios that you can qualify with, and the rates are crazy good. They're as good a rates as you'll find out there, and it just is geared toward making it easier, particularly for first-time home buyers, but you don't have to necessarily be a first-time home buyer to use the FHA program. There are a lot of people that use it the first time and the second time and the third time, so you can use it multiple times. And the fourth one that I was going to mention there is the USDA loan. Now this is a pretty good loan program. It's 100% finance, so it has that consistency with the VA loan program. But it's more like an FHA loan, and the reason this loan has been popular is because there's not a lot of default on them. They found that people that live in the rural areas, they tend to stay in their properties longer, and that's why they're comfortable. The default rate on USDA loans is pretty darn low. So it's a good program. There are some income limits to it. You can't make too much money, and your property has to be in what's considered by the USDA a rural area. Sometimes that's there's kind of some fine lines on there, but the income is probably one of the bigger reasons that a lot of people don't do that. So hopefully that makes sense. And again, I'm going to ask you if you've got questions, just hold those. And so what we're going to start here is we're going to talk about some more specifics about the VA loan program. And the reason, again, this is, I think, the absolute best program out there is because they offer low rates. And when I talk about low rates, one of the things that makes rates low is that the government endorsement of these loan programs, along with FHA, the premiums that are paid to the lenders are higher on these type of loans than they are on the conventional, the Freddie Macs and the Fannie Maes. And what that does, that allows the rates to go lower, to be offered lower, so that when the mortgage company does this, they are making as much money by offering lower rates. That's an important thing. So if you're a veteran, you can get low rates. The beauty of this is you don't have to have any money to put down. If you employ one of the little techniques that I encourage you to do, you might even not bring any money at all, and I'll tell you about that in a minute. So you got zero down, you got good rates, financed or no mortgage insurance. So mortgage insurance is what protects the lender from a default, and in this particular case, the VA dictates what that amount is, and it varies from the first time you use it to the second time, the third time, so on like that. But the other thing is, if you've had a disability, and usually a very minor disability, the VA waives that upfront mortgage insurance premium. So if you've got a slight disability, we've done a lot of loans for vets that had a disability coming out of the service, and their mortgage insurance was waived, so that's a good thing. Debt ratios are fair. They're a little bit higher than the conventional version, so that means that you can have a little bit more debt when you're buying a house. And just all in all, I think it's the best loan program available. If you are a vet and you're thinking of not using the VA program, I'd almost question why not. I mean, it's just such a good program. The only negative I can think of is that some sellers don't like to sell to people on VA loans because there's certain criteria that the seller might have to pay some additional cost that the vet can't pay. But again, for vets, it's a great deal. Let's move on to the next one. Government conventional loan programs. Now these are I kind of laid these out based on what I think are the best loan programs. So conventional loan programs, this is a big part of what's going on out in the marketplace. And there's a couple of good things about them. One, this is the one where people think that it requires 20% down. That's not the case. There are some loan programs for conventional that have as low as a 3% down. So 3%, $100,000 purchase price, that's a $3,000 down payment. $200,000, it's a $6,000 down payment. Majority of the conventional programs, that 3% down is a special program. Most of them are 5% down, and 5% is the minimum, and the guidelines are tighter. And what that means is that you can have less debt compared to your income to qualify. So the ratios, once you go over those ratios, the loan's not going to be approved. The mortgage insurance that's required only if you're putting less than 20% down, and the mortgage insurance is a factor based on the interest rate, your debt ratio, and your FICO scores. All are kind of a part of what makes up the mortgage insurance. And mortgage insurance is nothing more than default insurance, where the beneficiary of that insurance is the lender. And that's one of the things that they protect themselves if you're not putting 20% down. If you put 20% down, they feel like they'll be able to sell the collateral that secures the loan and get their money back. Well, if you don't put 20% down, then the mortgage insurance kicks in. Now, the beauty of conventional loan programs is if you have mortgage insurance, but you've got to remember that your house, as you live in it, generally increases in value as you pay your mortgage down. And so when the balance of your mortgage becomes 78% of what the mortgage is, or the house is valued at, which is a variable. There's a whole different story on that. But that's when that mortgage insurance will go away. Well, the mortgage insurance on a $200,000 house can be $150 a month, depending on what it was when you got in the house. So the fact that it goes away in anywhere from 4 to 7 years is a very positive part, because everybody likes to see their mortgage payment go down. Rates are tied to credit scores, and the minimum credit score, this is not really true. You can get a conventional loan down to a credit score of about 620, but they're tough. 660 is really the number where most conventional loans start, and what they do is they base the rates, the interest rate, on a tier. It kind of goes from 660 to 679, and then 680 to 699, and then 700 to 720, and then 720 to 739, and then 740 and above. Now, when you're 740, you get the best rates. But if you're below any one of those 20-point basis points, then the rates get worse. And it's not huge. I mean, from one level to another is not a big deal. But when you go from 740 to 660, there's a pretty substantial difference in the rates. So one of the reasons why, if you've got a 740 FICO, we definitely will want to point you in the direction of a conventional loan most of the time. Okay, and I think I already said that lower debt ratios are allowed. And one thing that's a little subtle to here, if you look at my little picture here, there's also, when you're doing a conventional loan, the people that are selling their house are more likely to accept a conventional loan over an FHA or a VA loan. And the reason for that is that conventional loan means that those people fit a higher standard of qualifying. That means that they have generally higher FICO scores, and they have lower debt ratios, and they are generally putting a little bit more down. Even though if they're putting 5% down, it's more than the 3.5% that you put down on FHA, and it's more than the 0% that you're putting down as a vet. So in this market, when people are fighting over houses and there's a bunch of people bidding on houses, going conventional could be a positive factor that could make a difference on that. The FHA loan program, this is a program that we do a lot. We help a lot of people with this program, and the key parts are, the rates are great. I mean, you get really good rates on these. The higher debt ratios are allowed, which means that you can have more debt and still qualify for the house. The down payment is 3.5%. That's all you got to put down. You do get some benefits for putting up to 10% down, but not much more than that. And you would only, if you wanted to, put more than 10% down. If you wanted to put 10% down, I'd probably push you into a conventional loan because you get more benefits doing that. Low credit score allowed down to 580. Now, if you've looked at a 580 FICO score or credit report, that's a pretty low credit score. That means your credit's pretty rough. Maybe it's possible that you don't have any credit, or maybe you've not been using credit for the last couple of years. But in many cases, if you've got scores that are in that 580 to 600, you've had some rough times in the past. One of the things that we like to do is we like to put people that have had the lower 600 FICO scores in the FHA program, because they still get good rates and they have the qualifying capability of the broader guidelines. negatives on the FHA loan, there's an upfront mortgage insurance premium that is financed in 1.75. It's pretty substantial. And then you have a monthly mortgage insurance premium that is not unreasonable. It's consistent with the conventional monthly mortgage insurance. And then the final negative about that is that the monthly mortgage insurance is on there for the life of the loan. You actually have to refinance out of that monthly mortgage insurance at this time. Now that could change. They've changed it a couple times in the last 5 or 6 years. So you just have to stay tuned on that. And the biggest thing that I like about the FHA is because a lot of people fit in there. They're more liberal qualifying guidelines. That means it's just a bigger box that you can put people in, where if you're using that analogy, a conventional box is a smaller box. A VA box is a little bigger than the conventional box, but an FHA is a big box, and it allows a lot of people in there. Okay. And then the USDA program, I think I mentioned a little about the USDA. It's 100% financing, so there's no down payment required. Similar to FHA guidelines, the guidelines are a little broader. They're not quite as broad as FHA, but they're pretty darn close. Got decent rates, not quite as good as FHA. They're only allowed in rural areas. So if you're trying to do a USDA loan in Harris County, it's just not going to happen because they've deemed that all of Harris County is not rural. However, if you go to Montgomery or you go to Brazoria, there's probably going to be some USDA properties out there. The home must qualify. Just because it's in Montgomery County doesn't mean it's necessarily going to qualify. And borrower income is limited. And there is a specific guideline that states that you can't, if you make 150% of what the median income is, then you're not going to qualify for the USDA program. So it's trying to help people out that are living rural and to help them that aren't making as much money as some of the people in other areas. So that's quick and easy. And then this is one that I think a lot of people don't understand, and it's really a big plus for people. That one of the things that we found, and this was actually a survey that was done by Fannie Mae back in 2003, but the biggest reason that people don't buy houses today and for the last 15 years is because they don't have enough money. And one of the ways that we can help with this is getting the seller to contribute to closing costs. Now, when the housing market is hot and people are jumping all over houses and there's competition to get a particular house, the seller has no reason whatsoever to offer a seller contribution. However, that's not the case all the time. There are many times when there are houses that don't sell right away. And it might be that they aren't updated. It might be that they need some work. It might be all kinds of reasons. It could be in a neighborhood that is not that popular. For whatever reason, there are things that a seller can do to incentivize the sellability of their house. And one of them is to put money down to help them pay for the closing cost. And going over the closing cost and stuff is another Webby that we'll do. But in this particular one, just know that what I put down here is that with the VA has an unusual plan where they can offer up to 4% in closing cost help. They can also do 4% of some other type of help, and that's a longer discussion. But VA, they're very aggressive about allowing the seller to help. Conventional, the maximum contribution on a conventional loan is 3%. So think about this. If you're buying a $200,000 house and you can get the seller to give you a 3% discount, then a lot of times what that looks like is that means $6,000 of the seller's equity is going to help you pay for your closing costs, your tax and insurance escrows, and any of the title company fees, and possibly even some of your homeowner's insurance for the first year. So those are very positive ways to buy it, and it just reduces by $6,000 the amount of money that you'd need to bring to close. FHA offers a 6% cap, and I'll be honest with you, I've never used a full 6% to help somebody close. You just can't use all that. I mean, it's too much money. There may be some areas where it makes sense, but in our area, 3-4% is about the max you're going to use. And then I also found that the USDA allows up to 6% also, and again, I'm just not sure you would use that. But this seller contribution to closing costs is a big deal. It's a great strategy, and in many cases it works. Now, let me give you an example of how this would work. Let's say that you're looking at a house that's priced at $199,995. Okay, so just under $200,000. Most people would offer $195 or $197 or $194, and they're not going to offer them full price right off, particularly if the house has been on the market for 30 days. And what you could do is you could go, you know what, I like this house. This is a house that's going to suit me well. Mr. Seller, would you take $199,995, your sales price, but would you pay 3% in closing costs? So in essence, what you're doing is you're buying that house for $194. You're basically getting a $6,000 discount on that house, but you're using that discount to help you pay your closing cost. And all of a sudden, people are going, okay, now if that's a 5% down on a $200,000, that means I need $10,000 to close, but my closing costs are all going to be paid. And that, when again, the closing costs are lender costs, title company costs, tax and insurance, escrow costs. And you can see that that adds up, where normally the amount that you'd need to bring on a $200,000 house might be $15,000 or $16,000. Now you're only bringing the down payment. That's why that can be a really good strategy. It's one of the ones that not everybody knows about that. So how much is needed? So how much money do you need? Well, here's what I do. Down payment is going to be, for most loans, it's anywhere from 3 to 5%. You have lender closing costs, and lender closing costs can vary a little bit, so you always want to shop for that. And obviously, I'd love to be able to quote you what I would do for you on that scenario. Third-party closing costs, most are the same. They include appraisals, inspections, credit reports, flood certs, that kind of stuff. And then there are title company costs. And the title company costs, again, are pretty consistent. There's a little variance here and there, a couple $100 one way or the other. It's not really the reason why you would choose one title company over another, but it is important that you know there are a difference. The tax and insurance escrows, this is a pretty substantial cost factor, and even though the taxes are going to be what the taxes are, you do get to shop for your insurance, and I always encourage you to be aggressive about shopping for your insurance. My common statement on this insurance question is, I've lived in the same house for 24 years. I've never claimed anything on my insurance. Now, maybe I may be an idiot for that, but we've decided that we use the insurance for the big stuff. We take care of the little stuff for ourselves, and we try to keep our insurance costs down. So when something really big happens, they'll cover us. Also, call for your own specific detailed mortgage estimate. What I did over here in this picture over here is I've got kind of a scenario of what I call as a detailed mortgage estimate. And the detailed mortgage estimate really shows all the closing costs, lender closing costs, third-party related fees, estimated title company costs, and you probably can't see a lot of these numbers on your screen. Maybe you can, but I do one of these specifically for you so that you can see exactly what the costs are. And down at the bottom, it's going to show you what your monthly payment is, and it's going to show you exactly how much money it's going to cost you to do this. And that gives you a good idea on whether you can do this, whether you can come up with the money in time, and how much money, if you got a seller contribution, that would mean. So it's just a really important and good document that allows you to see exactly what the costs are going to be. I've had a lot of people tell me it made a difference to them knowing that. So anyway, I'd be glad to do one specifically for you. All you got to do is give me a buzz right here at 281-348-9899. Let's go on. So here is what we've covered so far. Why buy a home instead of renting? We dispelled some mortgage myths. We did different loan program review, total amount of money needed, what to do now. Well, what should you do now? I think the best thing you do, if you've gone through and decided for sure that you do want to buy a home, the next thing you do is you need to get pre-approved. We need to take an application. We need to pull your credit. We need to look at your income. We get W-2s, paycheck stubs, bank statements, and tax returns. This allows us to plug in the right numbers so that we can determine what you're going to qualify for. And guess what? It's totally free. Doesn't cost anything. Well, it costs a few minutes of your time, and also it's kind of an exercise for you to find all those documents that you're going to need when you buy a house anyway. So if you're dreaming of buying that house, you're dreaming of that castle that you want to live in, I wanted to make sure you had my number down there at 281-348-9899. I'd love to chat with you about that, and we'll get you a free. What now? Well, determine if buying's right for you. If yes, get pre-qualified. The other thing that I do, I'm a bona fide credit scoring expert, and I can guide you as to what you need to do. It's amazing what you can do if you know how the credit scoring algorithm works, and I can help you get your scores up so that you get the lowest rate. It's a big deal. See what you qualify for. Between the time today and the time that you actually anticipate buying a house, I want you to save money. I want you to pay your debt down. And most important, I want you to call the Kingwood mortgage guy. That'd be me. So that would be a smart move for you. We have these, this is like a special. Yeah, I forgot about this. If you call and say, saw the Webby, we will pay $575 of your closing costs. And the reason I picked out that $575, that's what the cost of an appraisal costs. And $575 is not inconsequential. And we wanted to reward you for spending the time to watch this video all the way through. And obviously, if you didn't watch it all the way through, you wouldn't have saw that. But not only do you get our 5-star service, we will implement all the strategies we know of to get you the best loan possible, all the strategies to improve your credit score so you get the lowest rate, and our team will gently take you by the hand and guide you through the whole loan process. So love to do that for you and with you. This picture is just a happy group here. Just a side note that this couple is a happy owner, and this person in the middle with the baby in their hand, that happens to be my wife, who is a realtor, and we love to work together on deals. Just put in a plug for her. And in finalizing this, I am the Kingwood mortgage guy. I am licensed in the state of Texas. I do loans all over the state. I have family and friends in San Antonio and in Dallas, and done loans in Austin and San Marcos and Fort Worth and all those areas. But most of my business is done right here in the Houston metro area, and I'd love to work with you. I do have a link if you do a Google review for Kingwood mortgage brokers or Kingwood mortgage companies. A lot of customers have been very gracious in putting great reviews about me. I'm very thankful and humbled by that. And anyway, I appreciate you taking the time to watch through this video, and I hope that you'll call me. I look forward to talking to you soon. Bye-bye.